Hello everybody, this is Professor Lambert on business valuation of privately held companies. This is lesson number 7. This lesson will be a refresher on the market approaches to value. There are two major market approaches to value, and then there's a third one that you see less frequently, but it does exist in the real world, so we will discuss it. And what this video will do is it'll just refresh us on the market approaches, and then the next video will go into the actual Excel spreadsheet, and it'll look at the comparable companies method, which is one of those one of the three methods really. And we will navigate our way around that and get into some of the details so you can navigate your way around it. Let's get started. So as a refresher, there are two major market approaches. One is the comparable company method, also known as, if you say it the long way, comparable publicly traded companies, or the guideline public company method. A lot of people in the business just call this the comp method or the comps method, comp company method. What this does is it looks for companies in the public stock markets, and it looks for companies that are similar to the subject company that we're valuing. And using the stock pricing data for those publicly traded companies, as well as the historical accounting data that precedes the valuation date, so the income statement and the balance sheet, and we look through the notes of the documents that were available prior to the valuation date, or up to and including the valuation date, and we use the combination of market pricing information plus historical accounting data to come up with valuation measures. We also call those valuation measures valuation metrics, or sometimes multiples. And there are a number of multiples that we'll go over when we get to the Excel spreadsheet. What we're doing here essentially is we're looking for market pricing of similar companies to our subject company. For instance, if I was valuing a coffee company, I can go find the stock price for Starbucks on my valuation date. Then I can look at the historical income statement and balance sheet for Starbucks that preceded or were available up to and including my valuation date, and I can use those two pieces of data to come up with valuation multiples. And then I can apply that valuation multiple or some variety of it, derivative of it, to my own subject company valuation. And we're going to see how this manifests practically when we go into the Excel spreadsheet. The second market method is called the comparable transaction method, or known as also the mergers and acquisitions method. What this method does is it uses comparable transaction data. So when a transaction has occurred, for instance, if one company has purchased another, that we have the knowledge of the purchase price. We also have the available historical accounting information for the target company. That's the company that was acquired. And we can use those two measures to come up with valuation multiples. The difference between these two methods is that comparable publicly traded companies, or the comp company method, which is the first method, gives us a value that's on a non-controlling or minority interest basis. So the market trades all in small blocks of stock, minority interest blocks of stock. And as a result, when we look at our levels of value chart, if we take those multiples from the comp company method and we apply it to our company, we are at a marketable minority interest number. In contrast, the comparable transaction method, or the M&A method, mergers and acquisitions method, looks at situations where one company has been acquired by another. So usually those are controlling interest transactions. One company has said, we want to acquire 100% of XYZ Co., and here's the price we're going to pay to make that acquisition. And again, we have now a new market price for XYZ Co., and we can look at its historical data, and we can say, here's the valuation measure. The difference is that M&A method on the levels of value chart puts us on a controlling interest basis, so the top of that levels of value chart. And that's a really important distinction between the two. Now, is this always the case? There, like in the real world, in any industry you're in, or any sort of profession, there's always exceptions to the rule. So sometimes there's a merger and acquisition announced where one company might be acquiring a 40% interest in the target company. And usually, if you look closely at some of that transaction data, what may happen there is somebody's acquiring a remainder interest, meaning one company already owns 60% of the other. Now they're just acquiring the other 40%. Sometimes they acquire a smaller percentage investment in a company rather than 100% or 51%. But you need to look at each transaction in detail so that you know what the actual proper level of value is. The other thing, okay, so here's that point on the control versus minority. And so really this cannot be emphasized enough, that you really need to understand the data that you're looking at and just make sure you are using these measures in a way and you understand where that puts your company on the levels of value chart, your subject company. The third method, I would say, in the M&A method is not really a separate method at all, but it's a hybrid of these other methods. And what we're talking about specifically here is, what if we had a transaction in our subject company's stock? So again, what's the best way to price something? Well, you look at the price that somebody pays for it. Well, what if we were valuing a company, let's just say in 2023, but that company had a transaction where somebody acquired its stock and somebody bought the stock, somebody sold the stock in 2022, only a year earlier. Well, in that case, we don't have to necessarily we would still look for comparable companies, and we'd look for M&A transactional data, because we want to always search for those two pieces of data because they would help us determine value. But if we also have a transaction in our own subject company stock, we would want to use that transaction and at least consider what that transaction implied in terms of a value. So if last year somebody paid $1 million for a 40% interest in our subject company, our privately held company, we immediately have a great data point. We know that it's a minority interest stake. It's less than 50%. And also, and here's the other trick, if somebody's buying into our non-marketable privately held business, well, then that's a non-marketable transaction, meaning you still don't have the immediacy of a stock market with a quotation and instant liquidity, like we've talked about in some of these other podcasts. So the guideline transaction method, or the guideline or a market method, can be used in our own stock, the stock of the subject company that we're valuing. One of the key questions when you identify this type of transaction is it an arm's length transaction? Now, what the heck is an arm's length transaction? Does that mean it was like 34 inches from someone's shoulder? No, that is truly an arm length, but that's not what we're talking about here. In the business world, an arm's length transactions means that the transaction was negotiated between two parties who were unrelated and advocating for themselves. So, for instance, if I owned two companies, let's say I owned a coffee shop and I also owned the real estate that the coffee shop operated out of, so the land in the building, I own that in a separate company. Well, if I decide to charge $1,000 a month in rent to the coffee company from the real estate company, and I own both of them, that's not really an arm's length transaction. I'm the owner of both, so it's not two separate parties negotiating for their best interest. This is just me deciding unilaterally, well, what do I want to charge for rent? And the reason why that's important is because if I think about a rent expense, if I charge a rent that's higher than market, the market rate of rent, that means my coffee company is paying too much for rent and its profits are going to look lower. It's going to look like it's making less net income. If I charge a below market rent to the coffee company from my real estate holding company, that means the coffee company's expenses are understated somewhat because I'm charging below market rent, and therefore net income is overstated. And if I'm charging a market rate of rent in this type of transaction, then that's fine. As if it were a third-party landlord who determined, well, this is what coffee shop rents are going for these days, that would be fine. So this idea of arm's length is really important. You want to make sure that nobody is self-dealing or trying to shift income from one entity to another, or leave money in one other entity by manipulating the market rate of rent in my example. And we can talk about that more when we're face to face. But again, the whole big picture point of this is that if you do have a transaction in your own company's stock, you can use that as a potential transaction, and it gives you a good indicator of value if two parties had a negotiation to determine what that value was. Hope you found this review helpful, and we're now going to get into the Excel spreadsheet and look at some of the detail of that.